We have a lot of real estate CEOs that I feel like probably subscribe to your newsletter, are investors in Fifthwall, and they're constantly asking themselves, what am I not thinking about that I should be? Like, what is the kind of threat or opportunity that's hiding in plain sight? At a general level, what would your answer to that be?
Whew, that's a hard question to answer. I would say that at least on the venture side, from a real estate tech CEO, I want to be very careful about my burn right now. I think the capital markets on venture are going to get a lot worse before they get better.
And why do you say that?
A few reasons. One is the public markets still have not come back in any way in terms of being open to new IPOs. A lot of people still feel very burned in the public markets about what happened with the SPACs. And
meaning the public markets have not metabolized the amount of losses that just poured through the system, and correspondingly private markets have definitely not metabolized it.
Correct. And you're still seeing LPs. I think one of the challenges you're seeing in the venture market right now is a lot of VCs have not truly marked their portfolios to the actual value of those portfolios
I think
today.
That's exactly right.
And so LPs are looking at the current marks and saying, I'm overweight venture, so they're not investing in the new funds. When in reality, they're not overweight venture if there were real marks out there, but there's not. So this new generation of funds, the vintages of 2024, 2025, maybe even longer, are not gonna get raised. Talked to a bunch of VCs in the last month who've said it's the toughest capital markets environment they've ever seen, including 08-09.
We weren't around in 08-09, but what it feels like is that, in the past 10 years, there's been this like Cambrian explosion of different venture funds, all different types and varieties and sector focuses and theme focuses and geography focuses. And many of them are just not going to survive. And on the other side of that, you're going to have fewer GPs. I still think, I agree with you that LPs are trying to figure out, like, what do I actually own? Like, what is the value of these portfolios? And they probably won't know that with high resolution for a couple years. But I think on the other side of it, there is going to be an opportunity. But I agree with you, it's going to take a couple years at least for the losses that started in the public markets to work their way through to the private markets. One
thing Brad Grewe, your partner here, told me once, which really stuck with me, he was talking about Invitation Homes. And he told me that Invitation Homes did not buy its first home until 2012. 4 years after the crisis hit. I think a lot of people point to Invitation Homes and say, hey, they were one of the examples of a model that really capitalized on a downturn. But the distress didn't actually emerge in a way that was actionable from a capital market standpoint for 3 or 4 years. And I think it's gonna take some time for what's happening today to percolate through the ecosystem. One thing that scares me a lot, and going back to your question, would scare me a lot if I'm a real estate tech CEO right now, is the ubiquity of pre-seed, seed, and sort of Series A capital, complete absence of Series B and growth capital. And there's going to be a lot of companies that raised seed and Series A rounds that are not able to make it to B and growth. And I think that's going to be tough for a lot of companies. I think there's also going to be a lot of really interesting M&A opportunities in the next 2 to 3 years. The analogy between residential real estate and venture startups and the equity in them is maybe not so obvious, except when you consider that there's no way to short either. Right? There was an entire movie about how it was so difficult to short US residential housing. There's no way to short venture equities. So what just happens is these companies kind of run out the clock. And so I think the correction would happen faster actually in both markets if there was a way to short these positions, but there really is no mark to market. And so I actually think the analogy is super apt because it will take probably 4 years until you really see what the bottom is because there's no true way to short the long equity position. That's right. And so it will take time to percolate through the ecosystem and for these companies to kind of start running short on money. I know a lot of founders who have raised a Series A or even raised a large seed round that still have 24 to 48 months of capital in the bank. And they're not on trajectories necessarily to get a big growth round, but they have a lot of clock to run out, and there's really no pressure on them to do anything.
Totally, because the nature of preferred stock, meaning if these were public market companies, they'd be buying back their own stock because they think it's cheap, or issuing dividends, or
there's no mechanism for them to do that.
There's no incentives to do that. But focusing now on real estate CEOs, so CEOs whose primary business is owning, operating, developing real estate. What should they be thinking about that they're not thinking about?
Well, we talked a lot about decarbonization earlier. I mean, that's obviously the elephant in the room, I'd say, for real estate tech CEOs is how do you think about coming regulation? Is that going to hit more states? And climate resilience just writ large. I mean, insurance rates have shot up in a number of states, and it was a real surprise to a lot of property owners in California, Texas, Florida. And I'm concerned with, from a policy perspective, how we're approaching the insurance market.
What do you mean by that?
So in North Carolina, I think it was the governor just came out and said, we did a great job. We negotiated a reduction in a planned insurance increase. Property insurance was going to increase by 70%. Instead, it's only increasing by 15%. And I don't love that. That scares me, because insurance is trying to tell us something. It's trying to communicate where we should be building, how we should be building, and the true costs to what we're doing.
The price of catastrophic risk.
Exactly. And there is a political tendency when insurance is trying to tell us something to get in and futz in the insurance market and manipulate the market. And I think that just kicks the can down the road.
And so as a real estate owner, it should be looking at your insurance premiums and seeing, are these artificially low for the actual environmental risk or functional obsolescence of my assets on account of their climate liability?
Right, and it's not just about climate, it's also about construction costs have gone way up. If you had a building that would have cost $20 million to rebuild 4 years ago, that might cost $35 million to rebuild today. So there's a lot going to it, and then you compound that on the climate risk, you compound that with the tort risk, with some of the judgments we've seen recently on litigation. And you're seeing insurance rates go through the roof, and I think that's going to sadly continue.